Unrivaled Nation, happy holidays and happy new year. A lot of folks have asked me, Daniel, what is your outlook for 2024? Thinking about the stock market, thinking about investing in general. I'm going to talk about the current trends that we're seeing, as well as the elements of chaos that I expect we could see in 2024. So I'm going to share these different key aspects as well as how I'm thinking about investing right now. As always, if you enjoy educational investment videos, you're watching Unrivaled Investing. I do appreciate that thumbs up, that subscribe button, that like. So looking at the S&P 500 over the last 3 years, it's flirting with all-time highs. You've seen a significant rally in 2023, recovering the losses from 2022 for the most part. And now folks are wondering, is this new high territory? If you factor in dividends, it actually is new highs, but just looking at price, it's flirting with that. Why is it? What's driven it? Well, in part because you've seen market darlings like NVIDIA, where just last year it had a $300 billion market cap. Now it's $1.2 trillion market cap. This is up significantly, in part because of the AI revolution. You did have this inflection in demand that does partially warrant it. So you are seeing strong fundamentals with some companies, but other companies, you're seeing valuation expansion, where last year is trading in a low 20s earnings multiple, and now it's trading at a low 30s earnings multiple. And keep in mind, this was all during a period where Apple for each quarter reported a decline in sales. So that's really impressive work by the market to say, hey, we're going to pay more for declining sales. You're looking at broadly a change in sentiment. Last year, you had fear driving the market. Now you have extreme greed. I remind, it's worthwhile to remember the buy when others are fearful and sell when they are greedy. And I think when you see something like this, it should at least be a warning sign to you where we are with the market. Why has the market gone to this extreme greed level? In part because of the expectation that Jerome Powell has nailed a soft landing and that there will be rate cuts in 2024. And if they succeed in lowering interest rates, that could ease and help the economy. And you've seen risk assets of all types rebound. And recently, you've seen, this is a chart over the last 5 years of an ETF, IEF, which tracks the 7 to 10 year treasury bonds. It owns a portfolio of 7 to 10 year maturity treasury bonds. And you can see that it had the significant rally in the last few months of 2023. Over the last 5 years, its total return is pretty much break even. That includes the dividend that you're getting effectively by buying this ETF, which is the equivalent of owning a 10-year yield, or at least getting that 10-year yield. And so it shows you, if you didn't get this rally, this risk rally in the last few months, where people were saying, hey, I think interest rates are going to go lower, you would actually still be negative over the last 5 years. So this is broadly this perspective of, okay, maybe interest rates go lower. Maybe, the U.S. government gets its, financial house in order. We'll talk more about that in just a second. So what are my thoughts on 2024, and why did I bring up an element of chaos, elements of chaos? Well, first of all, in full disclosure, this is not financial advice. Also, a quick plug, take charge of your investment journey with unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for premium annual subscribers. The rate for the premium annual subscription is going up by the end of this year. So now's the time to lock it in, the favorable rate. So one element of chaos that I think people aren't appropriately factoring in, weighing in terms of the assessment, is that the trust with media has been declining for decades. And previously you had, like 3 main TV channels. Now you have countless, you have YouTube channels. You've reached the point now where artificial intelligence has become so good that you're able to see deep fakes that are going to confuse, or going to just, the trust, it's just going to blow a complete hole through any sort of verification. So you need to say, hey, in order to trust the news, you're now going to need to say, hey, is this from a source that I actually trust? Did they have someone on the ground? And this is going to make it so much harder, because you're just starting to see it with things like Midjourney version 6. I think, DALL-E 4 or 5, which is, a version from OpenAI. I think that'll be even better. So I think you're looking at a new paradigm that it's so important for investors to understand. I bet there'll be, fakes of me that you could create. I don't want that to happen, but it reinforces the idea. I mean, I certainly see it. I see people try to create, fake imposter accounts on Facebook and say, oh, I got my unrivaled investing on Facebook. I don't run, I have a much smaller thing, but I, for the most part, don't do it. It's mostly here on YouTube. So you're going to see that more and more where people are using, fake, and it's going to be because of this AI revolution. So this is super important for folks to understand. Another key element of chaos that I think investors should understand. First of all, interest rates. The yield that you can get on cash is much higher than where it previously was. I personally keep my cash at Interactive Brokers. See the link below. It's currently yielding over 4.8%. The reason why this is important is because I don't believe the higher interest rate environment that we're in has fully permeated through the economy. And I'll show you why I feel that way. You see headlines about how commercial real estate properties, in some cases, have dropped more than 50%. They're below the loan values, where banks were making loans on this over the past decade. Now they're underwater on it just because of a small move in interest rates. I mean, we're not talking about 10% interest rates. We're talking about 4 or 5% on cash. So therefore, folks are saying, hey, I need to get some sort of premium. In previously, the cap rates on these, this commercial real estate is 2-3%, maybe 3-4% in some cases. So it's just not competitive when cash is yielding 4-5%. And, the reason why I think you've so far seen the problems not really being realized is look at the delinquency rates on commercial banks. Look at the rate, and you're seeing around 1%. You see that during recessions, this delinquency rate. So this is delinquency rate on all loans across all commercial banks. Whenever there's a recession, it ticks up higher. You see in the early 90s, you see in the dot-com bubble, you see the Great Recession, it ticked higher. Right now, we are near all-time lows in terms of delinquency rates, despite the fact that you've had this dramatic move higher in interest rates. So I would say the problems that these banks will have when inevitably the loan comes due and the owner says, hey, this just doesn't make sense, I just don't think it has been realized yet with these banks. We haven't seen the credit cycle yet play out. You can just see it with the delinquency rates. You can see it with the charge-off rates. It just doesn't make sense. We're closer to one end of that bottom where you go, wow, this is really low versus what you'd say is an average over time, which arguably could be higher, could be, several percentage higher. So that is a key aspect that investors should consider. One other point is the Ponzi-esque financing that we've seen with U.S. finances. You see Ray Dalio, he's been pounding this drum for arguably the better part of this past year or two, saying, look, America's debt is not on a sustainable path. He called out how we are at a point in which we are borrowing money to pay debt service. That is the point of Ponzi financing. When you are borrowing funds to pay the interest on the existing debt you have, that is a real problem. And the reality is, I'm not seeing any leadership on either side of the aisle, for the most part, that's saying, hey, this is a red alert. This is a real problem. And so if you have, a president that says, hey, I don't care about, deficits in the years ahead, let's just keep spending like crazy, no matter what side you are, Republican or Democrat, this could be a real problem in the years ahead. And it does make me think that, this rally that we've seen in the treasury bonds in the last few months, is this the beginning of a new bull market where rates are going to be going lower? I just don't think so. When you have Ponzi-esque financing occurring, I just don't think you can say, oh, this is a sustainable rally, expect treasury bonds to keep rallying. And keep in mind, this has been a key reason why risk assets like stocks have rallied. Is because you said, oh, okay, well, those yields are going to go lower, therefore the valuations can expand. And you saw that, I called it out earlier with Apple. Sales declined. Hey, pay up from 20 times earnings to 30 times earnings. Why not? That's a key aspect here that you're seeing here. I don't agree with it. It's not something that I find, fundamentally appealing. I don't look at this and think, hey, this is a new bull market in terms of treasury yields. This is the opposite of what I'd say is a new bull market. Look at, so this is looking at AI Ticker Chat using its AI Predict feature. First month is free if you use the code below. And, it's saying, hey, what could be the range of outcomes for Apple stock in the years ahead? This is one of the largest components of the S&P 500. Once again, it was declining this past year, but let's assume some growth. Let's assume some record margins. Let's assume, around 25 times earnings multiple 5 years out. And it's saying effectively 19% upside and nearly 50% downside if you have a less rosy scenario. So I look at this and I'm thinking some of the largest components of the S&P 500 could have very inadequate returns over the next 5 years. Now, I'm not trying to be a bear. That's a super important point to make. I'm looking to be rational. I'm trying, you don't get paid by being pessimistic long term. You get paid by thinking, hey, there might be some guys that get a lot of attention by calling, a crash each year. And so like I think the Robert Kiyosaki's of the world, the Rich Dad, Poor Dad author, who like every year he calls, oh, there's going to be a great crash, load up on your golden gun sort of attitude. And like, that's not my attitude at all. I think the generational wealth building occurs through owning exceptional businesses that have unrivaled value propositions and, consider a global perspective. So I'm not trying to be a bear. That's not it at all. I'm just, let's be honest about what are the things that we're facing right now. And there are some legitimate, elements of chaos. And it should be pointed out, stocks rallied, bonds rallied, but so has gold. And it's interesting, from an element of chaos perspective, this is now approaching an all-time high. And so could that be pricing in a scenario where you start having this recession and you have to, because the US government is in such a position where, it might have to say, hey, we might have to tolerate a new, resurgence in inflation potentially because the Federal Reserve says, hey, we can't stomach much higher interest rates because we have so much debt. So I wonder if gold is pricing in this scenario of, maybe inflation does rebound, or maybe there are some problems in the future that, that's starting to price in this element of chaos. Because gold also rallied, this past year, not as much as some risk assets, but it is a risk asset that appreciates. So clearly people are saying, hey, maybe the central banks start losing control. So that it's something to be mindful of. It's something to watch out. My personal approach as I'm looking at the investment climate, how I'm investing, is it's important to understand. So everyone, some people like to quote Peter Lynch and, saying, hey, if you spend, 5 minutes a year or 10 minutes a year, thinking about the macro, you've wasted 5 minutes. That's how some people, I think that's a paraphrasing Peter Lynch. I personally just like to be aware of what's going on. And that's why I make these occasional macro outlook videos. But for the most part, my focus is on the bottoms up. What is this company doing? And how certain am I that it's going to be much larger in the future? And thinking about the inevitability of a business and looking at their past performance, looking at how management performed, and then saying, hey, does it sort of meet this 3 criteria of fundamental growth, cash flow to shareholders, and potential valuation expansion? So thinking about those 3 elements. So I, just because I've been cautious with, what I'm seeing with some of these macro themes, it hasn't prevented me from buying when I find something to be compelling. Subscribers know that in the last week or so, I bought a stock, it was growing, its underlying business at over 100%. And in the prior months when things were selling off, I actually added, significantly to my portfolio with a number of positions that have subsequently rallied quite a bit. But, the view is that investing should be more like grocery shopping than it should be the animal spirits of like, oh, I got to chase this because it's up. I look at this, we are in extreme greed right now. So it's a higher hurdle to get me excited about things. And my view is if I see something that I own and it sells off 10, 20, 30%, I would be interested in potentially buying more. So that's my approach is I sort of stock my favorite holdings over time. And maybe I start buying a little and then I go, okay, it rallied. Okay, yeah, maybe I add a little bit on the way up. Oh, it sold off. That's when I start buying. So it's a long-term, multi-year, hopefully multi-decade journey ahead. So I'm looking to move slowly, unless something falls, 50% in like a month or a day in some cases, then I might move a lot quicker. But for the most part, I move a lot slower with my own investments, where, hey, I'm looking for these exceptional companies, and I share what I'm personally doing once again at Unrivaled Investing. And I would think, hey, I might get some opportunities at the beginning of next year if things were to, let's say, sell off. And then I'd say, okay, maybe there's some buying to do. Anyway, and one subscriber recently asked, Daniel, given that we're in this sort of extreme greed environment, shouldn't you sell some of your positions? Now, some might want to do that. That's not personally my approach. And I've come to stomach that volatility. You stomach that sometimes your holdings drop 20, 30, 50%. Charlie Munger, may rest in peace. He used to say, look, the investors that can't stomach the inevitable 50% declines, maybe they shouldn't be buying individual securities. So that's an important data point. That's paraphrasing it roughly, and so it's worth understanding there's going to be volatility. So it's important to think about, what do you own? Does it have financial stability? Will it be able to survive if there is a recession? If some of these elements of chaos start to play out in 2024, I think there are these forces that you could see play out. And we haven't even talked about some of the geopolitical dynamics, which are very real. So I hope this video has been helpful for you, talking about my outlook for 2024, how I'm thinking about it. It doesn't fundamentally change how I'm behaving day to day. I'm still looking one company at a time, but it is something, these are the forces to be mindful of, because I believe we are in a different era than we have been in the years past, with higher interest rates, transformative, revolutionary technology, and arguably problems that hasn't really flown through the banking sector yet, with this higher interest rates. And you see valuations that are detached from the underlying fundamentals. So very interesting setup. I hope this video has been helpful for you. Please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.